Silver miners just printed new highs, and the part that matters isn't the chart, it's the stress underneath it. Because while the crowd is celebrating the breakout, there's always a second force in this market that shows up right when things look too obvious. The people whose job is to dampen volatility, hedge exposure, and keep price discovery from turning into a runaway headline machine. They don't need a conspiracy. They have incentives, they have balance sheets, and they have a playbook. But here's the problem for them. Miners making new highs is rarely just a cute equity story. It's often the first flare that the paper market is losing control of the physical signal. And later in this video, I'm going to give you the exact checklist for next week. What level matters, what confirms the move, what would invalidate it, and the one quiet metric that tells you whether this is a once-in-a-while opportunity or a very expensive trap. And that's where the real pressure starts. Right now, the loud narrative is simple. Silver's ripping, miners are ripping, retail's piling in. It's just momentum. And the skeptical narrative is just as simple. Miners always front run and then roll over. This is a blow-off. It's a trap. Both of those stories feel clean. Both of them are dangerously incomplete. Because in metals, the market doesn't move on vibes. It moves on structure. It moves on obligations. It moves on the plumbing, spreads, inventories, delivery windows, hedges, and the ugly little constraints nobody wants to talk about on the day the candles look pretty. But that ugly stuff is exactly what decides whether new highs turn into a staircase or a trapdoor. And the next detail is what flips the whole setup. Let's start with what you're seeing. Silver miners pushing to fresh highs. Not just one name, not just some random penny stock flyer. Broad miner exposure catching a bid, and juniors acting like someone lit a match near gasoline. That's normal when the market wants torque. If you're a fund manager or a fast money trader and you think silver has upside, you don't always want to chase the metal itself, especially if you suspect a pullback is coming. You buy the lever, miners or the lever. They're equity wrappers on a commodity with embedded operating leverage, and when sentiment flips, they can move like the metal is on fast forward. But that's not the part that matters. The part that matters is why this move is happening now, and why it's happening with this flavor. Because miners aren't just silver with extra spice. They're a proxy for expectations about future price, future margin, and future capital flows. When miners are making new highs, the market is quietly saying something like this. Even if silver wiggles, the expected path of silver and the expected willingness of buyers to pay for exposure has shifted. That's a regime change signal. But regime changes are exactly when traps get set. And that's where you have to stop looking at the headline and start looking at the microstructure. Here's the first principle. If a move is purely speculative heat, it tends to show cracks in the spreads before it shows cracks in spot. Spreads are where the professionals fight. Spreads are where tightness shows up. Spreads are where the market tells you if near-term metal is scarce or if it's just paper chasing paper. When the front of the curve gets bid relative to the back, the market is paying a premium for now, not later. That's a physical style signal. When the curve relaxes into contango, where future prices are higher than spot, then storage and financing costs are back in control, and tightness is not the story. So if you want to know whether new highs in miners are opportunity or trap, you don't start with the miners. You start with the curve, because if the curve is screaming, miners are not a meme. They're a warning, but that's not the part that matters. The second principle is the hidden detail almost nobody tracks properly. Inventories are not one number, they're categories. The market loves to throw around total inventory figures because they sound authoritative. But futures delivery doesn't care about total inventory in a warehouse system the way a casual headline implies. Delivery cares about what is actually deliverable under the rules, at the right time, in the right form, in the right place. That's where the registered versus eligible distinction matters. Eligible metal can sit in a warehouse and look comforting on a chart, but not all eligible metal is actually for sale. It may be owned, earmarked, or simply not offered to the market at a price the paper market wants. Registered metal is closer to the can be used for delivery bucket. When registered tightens, the paper market loses cushioning. When that cushion thins at the wrong moment on the calendar, spreads can jump, short positions can get uncomfortable, and suddenly you're not trading a story. You're trading obligations. Because if this one layer changes, the math changes. Now let's talk about the conflict force, another thing trying to suppress or deny or ignore the move, without any cartoonish claims. In a market like silver, a lot of participants benefit from stability. Producers want a hedge. Fabricators want predictable input costs. Banks and market makers want orderly flows so their hedges don't get ripped apart. Even long-only funds often want controlled upside, not gap risk chaos. So when silver starts moving and miners start exploding upward, the natural institutional response is to sell volatility, dampen the move, and lean on liquidity. Because liquidity is their weapon. They'll provide it when it suits them, pull it when it doesn't. And in thin moments, like late month, policy weeks, and futures roll windows, liquidity can vanish exactly when retail thinks it's safe now. And that's where people get emotionally ambushed. So why now? Why are miners hitting new highs right now, and why does it feel like the market can't decide whether to cheer or flinch? The calendar is the catalyst. You're in that late month environment where flows matter more than opinions. Month-end positioning, portfolio rebalancing, and risk budgets collide with major macro catalysts. If the market is also staring at central bank communication, rates, inflation language, the tone around higher for longer versus weak or closer to done, then the dollar and real rate expectations can whipsaw. Metals feel that instantly, silver especially. It's not a pure monetary metal, and it's not a pure industrial metal. It's the awkward hybrid that tends to move in bursts. When it decides to go, it doesn't politely trend. It lunges. And when it lunges into a thin liquidity window, you get the exact setup that separates opportunity from trap. A breakout that can either retest calmly or turn into a squeeze that gaps through levels and punishes anyone who planned to wait for a better entry. And that's where the real pressure starts. Let's pin down the mechanism so you can actually think like the market. In futures markets, price isn't just a number, it's a contract with rules. Every contract has timing, first notice day, delivery windows, roll periods. Most people never look at that. They just watch the chart and assume all demand is the same demand. It's not. As you approach key windows, certain players must act. Shorts who don't want to risk delivery must roll or cover. Longs who want exposure may roll, or they may stand for delivery depending on their objective. Market makers hedge, spread traders shift. And when the front end tightens, the market begins to punish anyone who assumed they could always source metal later at roughly the same cost. That punishment is paid through spreads and availability. This is why you can see miners surge even before mainstream commentators agree on a silver story, because the market structure is pulling on the chain behind the scenes. Now add one more ingredient, options reflexivity, not as the main engine, but as an accelerant. When miners run, they attract options flow. Calls get bought. Dealers who sold those calls hedge by buying the underlying shares to stay neutral, delta hedging. If price keeps rising, their hedge demand can rise with it. That's reflexive. It doesn't mean a guaranteed squeeze. It means the market can become sensitive around certain strikes and levels, especially when liquidity is thinner. That's why you can see a miner ETF or a basket of miners act like it's on rails for a few sessions, then snap back violently when positioning flips. And that's not the part that matters. The part that matters is what it forces participants to do when a level breaks. So here's your proof stack, and I'm going to keep it grounded. Not fantasy precision, not magical numbers, just real mechanisms and observable signals. Proof point 1, chart structure. Miners making new highs means prior resistance got absorbed. Markets remember levels because traders anchor to them. When resistance breaks, it becomes a test zone. If miners can hold that zone on pullbacks, meaning dips get bought, not puked, that's opportunity behavior. If the breakout immediately fails and price slices back under the level with accelerating volume, that's trap behavior. And it often happens fast because miners are crowded when momentum arrives. That's layer 1. Proof point 2, term structure and spreads. If front month tightness persists, if the curve resists relaxing, then the market is telling you the bid is not just paper chasing paper. It's demand for immediacy. That's the kind of pressure that can force price discovery higher even when sentiment is skeptical. If the curve relaxes quickly while miners stay euphoric, that's a warning sign that equity enthusiasm is outrunning metal tightness. That doesn't automatically kill the trade, but it changes the odds. And that's where the real pressure starts. Proof point 3, inventory categories, the hidden detail. You don't need to know an exact number to use this. You need to understand direction and context. If deliverable style buckets feel tight relative to recent history, it means the market's buffer is smaller. In that environment, any incremental demand, industrial procurement, ETF buying, investor bar and coin demand, even a shift in leasing can push spreads and availability faster than people expect. Conversely, if deliverable availability is comfortable and rising, then supply is not vetoing the paper market. In that environment, miners can still run, but the squeeze risk is lower and the move relies more on macro and flows. That's a different trade. And that's not the part that matters. The part that matters is whether supply chain realities are starting to veto the paper narrative. Proof point 4, supply chain constraints. Silver is not a clean turn the faucet commodity. A meaningful chunk of silver production comes as a byproduct of other mining: lead, zinc, copper. That means if silver price spikes, you don't just instantly ramp pure silver output. You're chained to the economics of other metals and to long lead times. Refining and logistics matter. Recycling responds, but not instantly and not infinitely. So when demand rises, or when available, deliverable supply feels tighter. Price can overshoot because the supply response is delayed. That's why silver can look calm for months and then rip in a way that makes people say, "Why didn't I buy earlier?" And then, right after, it can whip around and humiliate anyone who chased without a plan. Because if this one level breaks, the math changes. Proof point 5, institutional flows and behavior. When miners lead, it's often because equity capital can reposition faster than physical markets. Funds can buy miner exposure in seconds. That can front run spot because it's the path of least resistance for allocating risk. But eventually, if the move is real, you tend to see it echoed in broader hard asset behavior. Gold holding up, inflation expectations shifting, dollar softness, real rates wobbling, or risk hedges getting bid. If miners are partying alone while everything else is rolling over, that's a caution flag. If miners are leading a broader metals complex, that's more consistent with opportunity. And that's not the part that matters. The part that matters is whether the market is pulling in the same direction across multiple layers of the stack. Now, to be finance credible, we have to build the counterpoint properly, because yes, this could absolutely be a trap. In fact, the trap case is straightforward and you should respect it because ignoring it is how people blow themselves up in silver. Here's the trap case. Miners have a history of overshooting because they're levered equities. When they run, they invite speculative capital that doesn't understand mine economics, jurisdiction risk, capex realities, dilution risk, and cost inflation. If input costs rise, if energy costs bite, if labor costs climb, if political risk flares in key mining jurisdictions, miner margins can compress even if silver is up. Then there's hedging. If producers decide to lock in prices, that can cap upside in their equity story, even while the commodity stays firm. On top of that, parabolic moves invite demand destruction. Industrial consumers can defer purchases or substitute materials at the margin. Jewelry demand can soften. And silver, because it's partially industrial, is sensitive to growth sentiment. If macro rolls over, silver can get hit even if the long-term hard asset thesis stays intact. That's the bearish case. It's not crazy. It's not cynical. It's a real risk. But here's the problem. The bearish case is only correct if the market structure agrees with it. And that's where the real pressure starts. So how do you kill the trap thesis in real time? You don't do it by arguing on social media. You do it by watching what refuses to relax. In real squeezes or real tightness episodes, pullbacks don't feel safe. They feel shallow. They feel bought quickly. The curve doesn't collapse back into comfort. Premiums don't magically vanish. And miners, even when they dip, don't cascade. They hold key zones, that's the tell. Because the market can print a scary red day even in a bull regime. Silver loves to do that. The question is, what happens after? Does it bounce with urgency? Do dips get absorbed? Or does it grind lower as enthusiasm leaks away? The next detail is what flips the whole setup. Now let's get practical, because you're not here for poetry. You're here for what do I watch next, and what breaks if I'm wrong. This week and next week, you need a 3-part dashboard. First, the metals pivot. You want to identify the recent breakout zone in silver itself, the area that, if held, implies the breakout is being defended. If silver drops back through that zone and can't reclaim it quickly, the miner breakout becomes vulnerable because miners are a leveraged claim on silver's price path. Second, the miner's retest behavior. New highs are not the signal. The retest is the signal. The best breakouts often retest the breakout area, shake people out, then resume. The worst breakouts fall back under the breakout area, hover, then roll over hard as trapped longs exit. Third, liquidity conditions and volatility signature. When liquidity thins, price gaps. When price gaps, emotions hijack decision-making. If you see widening daily ranges, violent reversals, and gaps that don't fill, you're in a regime where position sizing and time horizon matter more than your conviction. Because even if you're right, silver can whip around violently and still be right on the weekly trend. That's not a contradiction. That's the nature of this market. And that's where the real pressure starts. Let's talk about the psychological game, because it's non-negotiable if you want to survive this corner of the market. Silver doesn't just move price, it attacks your decision-making. It does it with 3 weapons. Weapon 1, fake breakdowns. Silver will dip below a level, trigger stops, headline writers will call it over, and then it snaps back, leaving you either out of the trade or chasing higher. Weapon 2, spike and slam days. It will rally hard in the morning, make you feel late, then reverse, making you feel stupid. That's how it conditions you to stop trusting your process. Weapon 3, narrative whiplash. One day it's inflation hedge. Next day it's industrial slowdown. Next day it's speculative mania. Next day it's safe haven. The market doesn't care what story you choose. It cares whether flows are forced. So your shield is simple. Separate trend signal from noise. Trend signal is what happens around key levels on the daily and weekly timeframes, how the curve behaves, and how miners behave on retests. Noise is intraday drama, viral headlines, and the feeling that you must act right now. If you can't tell the difference, silver will use you as liquidity. And that's not the part that matters. The part that matters is staying in the game long enough to let the math play out. Now let's put the why now trigger into a clean timeline. Late month flows can create forced behavior. If you have major macro events this week and rate decisions, press conferences, inflation prints, then the market often positions ahead, then reprices violently after. Add a futures calendar dynamic where participants roll or reduce exposure, and you get a setup where small imbalances become big moves. Weekends matter too. Metals can gap over weekends, especially when geopolitics or macro surprises hit. If you're holding leveraged exposure into a weekend during a high volatility regime, you're taking gap risk whether you admit it or not. That doesn't mean don't do it. It means respect it. Price can whip around violently even if the thesis is correct. That's the credibility line most hype merchants skip, and it's the line that keeps you alive. So here's the two scenario lens, because it keeps you honest and it keeps you from marrying a narrative. Scenario one is the controlled pullback and retest. In this scenario, miners and silver cool off a bit. You see a dip toward the breakout zone, sentiment gets nervous, headlines turn negative, then buyers step in. You get higher lows, the curve stays relatively firm. That's the market digesting and building a base. If you see that, the opportunity is that the breakout is being converted into support. Confirmation looks like silver holding its pivot zone, miners holding above their breakout area on closing bases, and pullbacks getting bought with less drama over time. Invalidation looks like silver losing the pivot and failing to reclaim it quickly, miners slicing back below the breakout and staying there, and spreads relaxing in a way that suggests urgency is leaving the front end. Because if this one level breaks, the math changes. Scenario two is the continuation squeeze with gap risk. In this scenario, the market doesn't give you a polite retest. It pushes. Miners keep printing highs. Silver punches through psychological levels. The curve tightens. Volatility rises. And suddenly, the move is less about investors deciding and more about participants being forced. Shorts cover because margin pressure rises. Dealers hedge because call buying increases. Funds chase because relative performance pressure kicks in. Industrial buyers may accelerate procurement because waiting becomes more expensive. In that environment, you can see discontinuous moves, gaps, air pockets, vertical candles. Confirmation looks like breakouts that don't retest deeply, dips that get bought instantly, and spread behavior that stays stubborn. Invalidation looks like a sharp reversal that fails to reclaim key levels, signaling the squeeze impulse exhausted and liquidity came back in a way that favors sellers. And that's where the real pressure starts. Now, let's address the big opportunity or trap question directly without pretending certainty. Opportunity exists when the move is supported by structural tightness signals, by a calendar that forces behavior, and by retest action that shows the market is willing to pay up for exposure even after a shakeout. Trap risk rises when miners outrun the metal, when spreads relax and urgency fades, when liquidity returns and the move becomes easy to fade, and when the breakout fails on a closing basis. This is why you don't worship new highs. You interrogate them. New highs are a headline. Retests are the truth. Curves are the confession. Inventories are the constraint. And institutions? Institutions are just responding to incentives. Let me give you a quick mental model for why miners can look too strong and still be early. Imagine the metal is the engine and miners are the drivetrain. When the engine revs, the drivetrain can jolt, but the drivetrain also has slack, friction, and torque multiplication. If the market starts to believe the engine is going to keep revving because macro conditions favor metals because the dollar isn't in control, because inflation expectations aren't anchored because supply response is delayed, then the drivetrain moves first because it's easier to trade. That's miners. But if the engine sputters, if macro shifts, if growth fears dominate, if liquidity returns and squeezes unwind, then the drivetrain snaps back harder. That's why miners are both opportunity and trap. They're not a moral story. They're a leverage story. And that's not the part that matters. The part that matters is how you size and time your exposure based on which scenario you're in. Now, a word on manipulation, because this audience is skeptical of institutions, and for good reason. Markets have a history of behavior that looks like suppression at times, heavy selling into rallies, abrupt reversals, repeated defense of key levels. But you don't need to claim secret meetings to understand it. You just need to understand incentives and structure. If a bank is short volatility, it wants mean reversion. If a producer is hedging, it sells into strength. If a large player needs liquidity, it pushes price to where liquidity exists, above highs, below lows, around obvious levels, because that's where stops and orders cluster. This is market structure, not magic. The practical implication is the same. Don't let obvious levels hypnotize you. Expect the market to probe them. Expect fakeouts. Build a plan that survives them. Because that's where the real pressure starts. So what are you watching over the next week or two? First, watch whether the miners can hold their breakout zone on a pullback. Not intraday. on closes. Second, watch the metal's pivot zone and whether selling pressure is absorbed quickly. Third, watch curve behavior for signs of persistent urgency versus relaxation. Fourth, watch volatility behavior. Are moves getting more chaotic or more orderly? Orderly strength is usually healthier. Chaotic vertical strength can pay fast, but it can also reverse fast. Fifth, watch the broader macro backdrop, dollar behavior, real rate expectations, risk sentiment, and how gold behaves alongside silver. Silver loves to outperform late in a metals move, but it also loves to punish late buyers with sudden drops. If you respect that, you stop being surprised. And when you stop being surprised, you stop making panic decisions. Here's the simplest way to frame risk management without telling you what to do. Treat this like a regime that can trend and whip at the same time. That means you don't confuse being right with being comfortable. You can be right and still face a brutal drawdown on the way. If you can't stomach that, you either reduce exposure, widen your time horizon, or step back. The market doesn't reward martyrdom. It rewards staying solvent and staying rational. And that's not the part that matters. The part that matters is that volatility will be used against you. Headlines will weaponize it, influencers will weaponize it, and your own brain will weaponize it. Your job is to not hand your decision-making over to a candle. Now let's circle back to the hidden detail one more time, because this is the hinge. Everyone can see miners at new highs. Everyone can argue about whether it's bullish or a trap. But the underappreciated mechanism that reframes the whole story is deliverable tightness versus headline inventory comfort, and how that interacts with the calendar. If deliverable supply is not as abundant as it looks on a total inventory chart, then spreads and delivery dynamics can pressure shorts and market makers at exactly the wrong time. That can turn new highs into can't unsee it. Because once the market believes the front end is tight, behavior changes, buyers pull forward, sellers demand premiums, arbitrage becomes more aggressive, and the paper market has to reconcile with the physical reality, not the other way around. But if deliverable availability is fine and the curve relaxes, then the move can absolutely be a momentum burst that fades when macro shifts or when equity risk appetite cools. This is why you're not betting on a slogan, you're watching a mechanism. So is this a big opportunity or a trap? It's both, until the market picks one, and the market picks by what it forces people to do next. If you see controlled retests and persistent tightness signals, opportunity odds rise. If you see failed retests and relaxed urgency, trap odds rise. And if you see a continuation squeeze, respect the gap risk, because it can reward and punish in the same week. Near the end here, I'll give you the checklist in plain language, because that's the payoff you were promised. 1. Identify the recent breakout zone in miners and in silver, and don't get hypnotized by intraday noise. Watch closes. 2. Watch whether pullbacks get bought quickly or grind lower. Quick absorption is strength. 3. Watch curve behavior and spread firmness for the real tightness tell. 4. Watch volatility. If ranges expand and reversals get violent, size accordingly because the market is in extraction mode. 5. Keep the two-scenario lens, controlled retest versus continuation squeeze, and don't force the market into your preferred story. If controlled retest confirms, you're looking at a potentially durable uptrend. If continuation squeeze confirms, you're looking at a fast move with fast reversals. High opportunity, high risk. If key levels break and fail to reclaim, you're in trap territory, and the market is telling you the breakout was a liquidity event, not a structural shift. Because if this one level breaks, the math changes. And a final note, because this community matters more than the ticker. If you're the kind of investor who refuses to be emotionally yanked around by headlines, if you're here for mechanisms, not memes, then you already have an edge most people never develop. Stay with that identity. Don't outsource your conviction to a green day or a red day. Use the checklist. Watch what the market forces participants to do. And let price action plus structure, not vibes, decide whether this breakout is the start of something bigger or the trapdoor that shakes out the late crowd.